Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, today we want to go over the new regs in terms of the pre-purchase and post-purchase part of the investment portfolio. Because many bankers are asking us, well, what should we have in our policies to meet the new regs? Well, when we look at policies, we need to look at first the credit criteria that you're going to have. So when we look at that credit criteria, for instance, the regulators want you on corporate bonds and municipal bonds to determine whether or not the security is investment grade. Once again, investment grade. So how do we do that in terms of our pre-purchase and then also following up post-purchase on a going forward basis in terms of what creates investment grade? One of the no-nos in here is you can't use the rating agencies to determine investment grade. One of the things, though, that we've suggested in policies is that you can still use the rating agencies as a guideline. So if, for instance, your minimum rating in your current policy is a minimum A, is that then what we can do is to sit there and say that's a guideline. But more importantly, to determine the investment grade is that what you need to do is to essentially look at, for instance, the S&B ratings. And what we suggest is putting in there that every security, municipal, corporate, when it goes into the portfolio, should be an S&B 1. This is S&B's highest grade in terms of securities. One might sit there and say, well, does that mean it's a AAA based upon Moody's and S&P, which would reduce our overall yield that we're able to get? The answer to that is no. We look at things much different in S&B than how the rating agencies look at it. So you could have an A-rated security, for instance, from Moody's or S&P that would get an S&B 1. The other aspect that you could do is to sit there and list out a criteria of what you look at to determine whether or not a security is investment grade. Looking at the financial statements. Looking at, for instance, demographics, which should also be included determining that investment grade based on what the regulators want to see. And then we look at it in terms of that pre-purchase analysis. Of course, we want to look at the security in an up or down, up 300 basis points. What does the security do if rates were to move down or up? Now you could sit there and say, gee whiz, interest rates may not move down. But the thing is that this shows certain risks in a security. Are the risks imbalanced when you look at the security? The other thing that you need to be able to do with corporates and municipals is to look at pricing. Is the pricing on this security consistent with other like securities in the marketplace? So when we look at it, it's not only rating investment grade that the regulators want to see, but they want to see pricing consistency along with that shocking and any other analysis that you would deem to be important. Once again, the pricing does not apply to any kind of U.S. agencies or U.S. agency mortgage-backed securities. It's only on municipals and corporates. So when we look at other types of securities in here, is that it needs to show that consistency in pricing, that analysis up and down 300, and how you determine the overall, how the security is investment grade. We then look at the post-purchase. And once again, the post-purchase is as important as the pre-purchase follow-up. For instance, one of the things that you can look at are the S&B ratings. Have they changed? So that what we say on an overall portfolio of municipals or corporates is that we want to have an average between an S&B 1 and 2 on average in the portfolio. We want to be able to sit there and see deterioration, and if deterioration is happening on trend down to, say, an S&B 3, for instance, you may consider selling that particular security when it reaches a 3. But you want to have analysis is telling you what is going on with that particular security, so that if you do hold an S&B 3, which many times makes sense, is that you want to have the documentation in place in terms of what's happening with that particular credit. We then look at, on average, you can also do, some banks do an average rating, applying the rating agencies and coming up with an average rating that you don't want it to get below, for instance, that A level on minimum. So once again, you can use that as a guideline. And of course, we look at it from the standpoint of looking at that up and down 300 basis points on each security, as well as the entire investment portfolio. Another thing that you can do, which you can put into this policy, is also looking at not just states for municipals, for instance. What we do is that we actually break the entire country down into economic zones. And when we look at economic zones, we think that's a better way to look at it than state concentration. So for instance, one of the things we put into some policies is that per economic zone, you can't exceed 15% of capital, so that you're not concentrated into one particular economic zone in the country. When you think about, say, like a state like California, it's not just one economy, but there's multiple economic zones that are different from San Francisco to San Diego, different in the farm regions of California. Look at Pennsylvania, for instance, our home state. You look at our Lehigh Valley is very different economically than Philadelphia, is very different from the whole Marcellus Shale Zone, which Ed has talked about in terms of those natural gas findings. That's an entirely different economic zone than what you have in other parts of the state. So we think economic zones make sense, and then placing it in the policy in terms of what that concentration risk should be. So when we look at policy in here, what you want to be able to do is apply how you're going to be looking at that pre-purchase and post-purchase, and then look at it from the standpoint of translating that into language in the policy, so that the two, in terms of what you're doing and how you're moving forward with the investment portfolio, is then reflected in policy. And there I feel that you'll meet what the regulators are looking for. And of course, we can help you with the S&B ratings on municipal bonds and corporate bonds. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.